Welcome to the CNBC TV 18 Citizens Monetary Policy discussions. The upcoming RBI policy has become a deeply divided debate after the second quarter GDP growth came in at a strong 8.2%. Yes, the governor said Reserve Bank has space to support growth, but is there a need to support growth has become the new question. Joining me are Citizens MPC members Soumyakanti Ghosh of SBI, Samiran Chakrabarti of Citi, Sonal Verma of Nomura, JP Morgan's Sajid Chinoy, and our chairman, Dr. Pranab Sen, the former chief statistician of the country. Gentlemen and Sonal, thank you very much indeed for your time. Actually, let me start with the lady. Sonal, 8.2% growth. How can you justify a need for a rate cut? Will that pull back the MPC's hand?
Yeah, Lata, I mean, clearly it's a tight decision this time around. I think taken at face value, the 8.2 and for FY26, where we are now tracking closer to 7.5, does not suggest there is a need. I think we need to sort of dig a bit deeper, though, and a more nuanced analysis in terms of to what extent do we take these 8+ readings on GDP at face value? What is the role of low deflators in actually accelerating the real growth? Do we think that the output gap in India has turned positive based on the broader swath of economic data, including the credit gap, current account gap, momentum in core inflation, etc.? And I think the forward-looking view as well. I mean, as the deflator is going to drop even further into the negative territory in Q3, and that will again hold up real GDP in the next quarter. So we'll be having the same debate 2 months later. And therefore, I think, the forward outlook in terms of do we think steady state growth has stabilized in the 7.5 to 8% range? If not, if growth is going to revert back to 6.5, 7%, then the output gap is not significantly positive. So I think at face value, yes, there isn't a need, but I think we need a deeper analysis and discussion on the nominal growth slowdown and whether we think output gap has turned positive. Our view is it is not positive, and the deflators are exaggerating the real increase.
Okay. Sajid Chinoy, if you have joined us, a similar question to you actually. Is there not increasing conviction, at least for the last 3 or 4 quarters, GDP is coming higher than market estimates. So maybe we are in a higher potential growth. Or do you think this is a one-off blip because of the low WPI and we will revert back to 6% and growth needs help?
Well, Lata, good morning. I'm not even sure we need to go into those assessments when deciding what the RBI should do. What is the RBI's mandate? The primary mandate here is to keep inflation close to 4%, right? While keeping an eye on growth or while supporting growth. But it's very clear that the primary mandate is on inflation. And 10 years into an inflation targeting framework, it's very important from a credibility perspective to implement the mandate symmetrically. If overall headline inflation was tracking 6%, which is the upper end of the RBI's corridor, most analysts would say the RBI needs to hike rates here. This year, overall inflation, even if before the GST cuts kicked in, was running at about 2.2 or 2.3%. If you look at underlying inflation, which is to look at core inflation, correctly adjusted for gold prices and fuel prices, that's been running at less than 3% for a year. So if your primary mandate is to keep inflation close to 4, inflation is currently at 2%, underlying inflation is running at 3%, suggesting that there is still slack in the economy, it's very clear to me that, the decision is clear that you need at this point to cut rates to maintain the primacy of your mandate. Judgments about, output gap are harder to make, but if underlying core inflation is running at 3%, that still tells you there's slack in the economy. And so the RBI needs to be supportive of that at this point in time. So I think taking a more puritanical view of the inflation targeting framework, which I think is the right thing to do at this point in time, avoids, some of the questions that Sonal raised.
Okay. No, I agree. But, the RBI has not been all that symmetrical. During COVID times, even when inflation was above 6%, they did not hike with good reason. So, I mean, there have been exceptions to the rule, but we will leave that to the official MPC. Let me get to Soumya. Shaubhya, the RBI also looks at forward inflation. And that, given the low base, may be close to 4% or even higher. So, do you think we can run away, assume a rate cut simply because the last number was 0.25%?
No, I think we are living in a world of uncertainty, and a new uncertainty is the GDP, strong GDP growth, which has now become a certainty. So my sense is that I think let's dissect it into the following points. The first thing to note is that I think inflation, forward guidance of inflation in a situation when there is significant uncertainty is always very difficult to give. I think we started the year, the central bank started the year with an inflation forecast of 4% in April. It went down to 3.7, 3.1, and now there is a 2.6. Now there is every possibility that the final inflation number could be closer to 2%. Next year, we have started with 4.9. We are now at 4.5, but with the new CPI base and given the current inflationary trends, I think I will not be surprised if it runs decisively below 4% also for the next year when the MPR report is published in April. So having said all this, I think so the 1 year forward guidance at this point of time, looking into it and making, even though that's actually the mandate of an inflation targeting central bank, is very difficult to make.
Okay.
So my sense is that while I agree with the point that inflation is going to undershoot significantly, but you also have to admit that growth has been strong. Last year, we were having a debate that why the GDP is so high from the GVA. That was because of indirect tax collection. This year, we are having a debate that whether the GDP is high because of deflator. Whichever way we can argue, we need to understand that the GDP growth has continued to be strong. We can also look into the arguments in terms of a glass half full. For example, the nominal GDP growth rate could have been higher and the GDP growth could have been lower, but that's not been the case. So we need to take a sacrosanct view. Yes, inflation will significantly undershot, but at the same point of time, in a world of uncertainty, you have to keep the gunpowder in your arsenal over a longer period of time, and there is no harm if the rate cut cycle or the stance of the central bank remains in this current mode, at least in the near future. Because what is important is the understanding of the current scenario in terms of growth inflation trade-off.
Okay. So I'm smelling the first person who's not going to vote for a rate cut, but we will wait. Let's get to the other big issue, Samiran Chakrabarti, on the trade data and the BOP. Will that be a worry that we have deficits both in the current, rising current account deficit and persistent capital account deficits? Will that be a worry for the Reserve Bank?
Thanks, Lata. I guess from the October policy to the December policy, if I have to find out one factor which has changed really rapidly, that has been our expectation about the balance of payment deficit. We were thinking that there's a possibility that this October-December quarter could actually turn out to be much better for BOP, but whatever we are tracking, this quarter could be somewhere around $15-20 billion of BOP deficit again. And that would mean that for the first time ever after at least 1991, that India is going to have 2 consecutive years of BOP deficit. And that's something which at different levels would feed into the policy decision also in our view. And it's 2 ways. One is obviously in a BOP deficit situation, you would want some amount of interest-sensitive flows to come to the country. And to that extent, there is lesser need for rate cuts. And second is that this BOP deficit feeds into INR liquidity and in turn feeds into bank deposits. We are already seeing banks' credit deposit ratio reaching all-time highs. At this juncture, further rate cuts could worsen that pressure on the credit deposit ratio. And to that extent, also, there could be an argument for RBI to wait out till hopefully by the 4th quarter of the fiscal, we start seeing the BOP start improving. Then maybe it's a better time to consider the rate cut.
Fair enough. But some may argue that this problem should be better addressed with liquidity, but I will come to that in a bit. Dr. Sen, as the former chief statistician and a person who has seen many cycles of deflator surprising us, what would your advice be to the Reserve Bank about the quality of growth and whether it needs help?
Well, this is an important question, Lata. The fact of the matter is that as the current system stands, our estimates on nominal GDP are far more accurate than our estimates of real GDP.
Oh,
The nominal GDP are really current data. But then you're using price deflators, which have been outdated by many, many years. And then it gives naturally a rise to a suspicion that too much is being driven by the prices. The nominal data is tracking weak, but prices are tracking even weaker, which is giving you high real. Now, so the whole question is going to be not so much as to what your expectation of inflation is, but the extent to which the MPC actually trusts the price data.
Oh.
Is the price data telling me the truth and nothing but the truth? So far as agriculture is concerned, the worries on that count are less. But insofar as everything else is concerned, whether it's the CPI or WPI, I think there are grounds for serious concern.
okay. So it looks like you're going to advise caution, sir, but why don't we put it to vote? We'll take one vote now and then take a second vote at the end of the second half of the discussion. So the first question I'm going to pose to my guests is obvious. What will the MPC do to interest rates, repo rate, on December 5th in the policy? Let me start with you, Sajid. What do you think they'll do?
A 25 basis point cut.
Thanks, Samiran.
A pause.
Pause. Okay. Already there's disagreement. Sonal,
25 basis point cut.
2 cuts and 1 pause. Saumyo,
We are going for a pause.
2 cuts, 2 pause. Chairman, casting vote, sir.
Pause.
Pause. Okay. So our Citizens MPC is going with a no-cut expectation for December 5th, but it is a close vote. Let's take a break. We will continue our conversation and ask the more serious questions on liquidity, global impulses, and what will be the next steps in monetary policy coming up after the break.